In this presentation, we will apply a credit or advance payment to an invoice. In other words, we will create an invoice and apply to that invoice a credit or advance payment from that customer, lowering the amount or having a partial payment on the invoice that we enter within QuickBooks Online. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Here we are in the Get Great Guitars file. In order to get an idea of what we are doing, the objective, let's hit the plus item up top. We're going to be in the customer section. We had that kind of unusual item that happened here, that being that we had an advanced payment, meaning we got a deposit for a guitar. So our imagination here is we got a payment, someone wanted a guitar, they gave us the deposit up front for us to hold on to that guitar or to order it. And now we're going to make the invoice, which we did. Now we're going to make the invoice and apply out that advance payment. To get a further perspective of this, let's run our report on the left side. So we're going to go to the reports. We're going to scroll down to the Who Owes You report. And we want to take a look at the accounts, the customer balance detail report. The customer balance detail report. And in the customer balance detail, we can see this reflected by this payment from Anderson. So we have Anderson here, and it has a negative receivable. That means, in essence, that we owe Anderson. Anderson doesn't owe us. What we owe Anderson is either that $250 back, the money that they gave for us as a down payment on the guitar, or the guitar. We're hopefully going to provide the guitar, completing the transaction, and getting paid for that work. So to do that, we're going to enter an invoice. So I'm going to right click on this tab up top so we can keep this customer detailed report. Right click and duplicate. And then we're going to work on this tab by selecting the plus item up top. We're going to create an invoice just like we normally would. The only difference here being that we already have a partial deposit. Remember that an invoice means that we're sending this. So we can imagine us sending this guitar to the customer with the invoice basically involved, or billing the client, invoicing the client for this guitar that we have received and received a partial payment for. We're going to say this is going to Anderson. Customer email. We're not going to enter the email. Billing address, terms, net 30. We're going to say that the date on this will be 02/18/19. That's February 18th, 2019. Therefore, the due date 30 days later in accordance with the terms given to us by QuickBooks. Then we're going to scroll down to the product and service. We're going to say that we sold another ELP, our standard ELP guitar. So that's going to be our standard guitar. We'll type in ELP. There's what we sold. It's an Epiphone Les Paul. The quantity will be 1. We're going to say the 500 is the rate given to us by the system because it's in there as a product. It will have tax related to it. If we select this item down here and just click off of it, it'll then calculate that sales tax. This being the New York sales tax, it's calculated by QuickBooks in accordance with the region. We want to make this a generic 5%. So we're just going to select this sales tax and scroll down, and we're going to override the sales tax and make it just a flat 5%. And save and close that. Or let's not do that. We're going to confirm the override. And we're going to say other is the reason, and now confirm the override and close. And that'll change it to that $25. So there we have the $25. Now this is just going to be the standard invoice that we have, as if we just sold this invoice or sold this guitar to the customer. We're billing them, accounts receivable is going up, sales is going up by the 500, accounts receivable going up by the 525, then the difference 25 going to the sales tax payable, and the other side of inventory going down, that amount not on this return, but being given to us by the item number. The system knows that, QuickBooks knows that number. And then cost of goods sold is going up, the expense related to the sale of the guitar. We don't here see the credit amount that has already been paid to us. There's been an amount already paid. What we'll do now is save this and see if QuickBooks then applies out the credit, the prepayment, to the invoice that's now outstanding. So I'm going to say save, and QuickBooks says, hey, there was an outstanding credit, I'm paraphrasing here, of $250, a prepayment that we applied to the invoice. That's what we want. And that's the point. That's the point of us putting that prepayment in the accounts receivable. That's the account that will track the information by customer. So that's the account that we need that prepayment in, that advance payment, that deposit in, so that QuickBooks will give us this message and say, you know, they've already paid you something. We're going to apply it out to this invoice. So we're going to say, okay, that looks good. And then if we scroll down, now we see that applied out. There's the 525, there's the 250, there's the balance due, the 275. Now we can go ahead and send this item out to the customer and expect the payment of the balance due, that of the 275 at this time. So we'll go ahead and save and close this. And the amount of the invoice is going to be much the same. So the recording of the invoice doesn't change. The only difference is that we already had some payment by Anderson for that invoice. So now we can see that there's an outstanding balance of this 275 because we have the invoice and the amount applied to it. So if we select this invoice, we then of course see the invoice for Anderson for the 525, 250 applied, 275 remaining. So I'm going to close this back out. We no longer have that negative amount. Notice that negative amount in the receivables is a problem for a while, but only a timing difference. Once we complete the transaction, then it's no longer a problem. Our accounts receivable is correct in conformity with accounting standards. I'm now going to go to the normal balance sheet and we'll check out the process of the invoice being recorded, and we'll note it'll be basically the same. It'll be the same as any other invoice, the only difference being that there had been a prepayment. To do that, we're going to pull this to the right. I'm going to go back down and go to the balance sheet. So we're going to go to the reports. We're going to go to the standard and balance sheet, our favorite reports, scrolling up top, changing the dates from 01/01/19 to 12/31/19, January through December 2019, and run that report. We'll see up top in accounts receivable, if we select that item, we scroll down and we should have the invoice that we just created. There it is, 525. Notice it's the full amount, even though there's a prepayment. So the full amount of the invoice is being recorded. So if we scroll down, it's recording the invoice at the 525, even though part of it had been paid. This invoice is now recording the invoice, increasing the accounts receivable by, because that's what an invoice does, by the 525. It just so happens that within accounts receivable, we already had this 250 that we are now applying to it. In other words, if we close this back out, we see right above that 525, there's the 250. These two match out. These two tie together. Scrolling back up, if we go back to our balance sheet, then the other side is going to be on the profit and loss. And I'm going to right click on this account up top, or this tab, and duplicate it. And then we'll scroll down to the reports on the left side. We now want the profit and loss report, our other favorite report. Scrolling back up, changing the dates, 01/01/19 to 12/31/19, January through December 2019, and run that report. We then see up top, we have the sales of products, selecting that. Scrolling down, there's the 500. Again, the full sales price for the invoice. If we select that full sales price, scrolling back down, it's not the amount of the sales price plus the tax, just the sales price, but we didn't decrease it by the prepayment. We're still putting it on the books at the sales price. The difference is the $25 sales tax, closing that back out. That'll be on the balance sheet. Let's go scroll back up and go back to the report summary, back to the income statement, and then go back to the balance sheet on the prior tab. And then the difference is going to be a liability in the taxes payable to us that go into the New York Department of Taxation. But basically just taxes payable. I won't go into there, but that's where the 25 will be. And then also the inventory is going down because we sold inventory. If we select that item, scroll down, we then see then that this invoice is bringing down inventory by the full 400. That 400 isn't on the invoice. That's not because of the prepayment in any reason. It's just that the cost is related to the sales item and isn't on the invoice, but the system knows it due to it being in the sales item. Closing this back out, scrolling back up, going back to the balance sheet. Now let's look at the profit and loss. The other side of that is going to be on cost of goods sold, the expense. We select cost of goods sold. There's the 400 for that invoice, selecting that 400. Then we see our invoice once again. For more accounting information and accounting courses, visit our website at accountinginstruction.info.